Good afternoon, or I should say good morning, because we're in Calgary. My name is Maria Mangiacavallo. I'm the Vice President of Commercial Banking in Quebec at Scotiabank. I lead a team of approximately 100 relationship professionals dedicated to assisting mid-market Canadian businesses with their day-to-day banking, their trade and financing requirements. Scotiabank is a proud supporter and gold sponsor of the M&A Gala. We are also national members of the M&A Club, and I'm also a proud member of the M&A Advisory Board. So a little bit about the M&A Club. Since 2009, the club has become the association that represents Canada's M&A professionals for transactions and financing, primarily in the mid-market space. The founder, Bram Elkin, who you can see on the screen, had a vision to establish a network of M&A professionals with the goal of keeping medium-sized businesses alive and well in Canada. So since its inception, the M&A Club, its reach has increased. We started local, we went from regional to provincial to now national, and Bram just informed us we're also international. So very exciting and good work, Bram. Thank you very much for setting this club up. If you become a member of the club, you do have the ability to continue to expand your network, through access of, we're now 19 Canadian clubs across Canada. So you would have access to the members and the webinars, as well as access to our deals listing, which is updated every 2 weeks, and as well as access to the contact info of all the webinar attendees after each of the webinar presentations. I'm also been informed by Bram that we are opening up an M&A Club in New York City, and that's slated for fall of 2021. And when the live meetings do start, as a member, you'll have access to that content as well. So today's webinar is number 77. We've held a total of 76 webinars this year across Canada. And so I'd like to get started by introducing to you Greg Shannon. So Greg is a partner of Gowling WLG's Capital Markets, M&A and Private Equity Groups, as well as the Tax and Private Client Services Groups based in the firm, based in the firm's Calgary office. So Greg's practice encompasses corporate finance, M&A, tax, and corporate governance. Greg has worked in both Canada and the US and uses his significant cross-border experience to inform his practice. Greg is an active member of Calgary's local business community, and for the past 3 years, Greg has also acted as president of the Calgary chapter of the M&A Club. Thank you, Greg, and I'll turn this over to you so you can set the stage for today's webinar.
Great. Thank you, Maria, and welcome everybody. And thank you for that nice introduction. I also have from my Vancouver office, Cindy Laval, one of our corporate finance partners and energy lawyers in the Vancouver Gowling's office. So I want to introduce Cindy, and she can say a few words about herself, as she is the brand new president and chair of the M&A Club of Vancouver. So over to you, Cindy.
Great. Thanks, Greg, and welcome everyone. Yeah, just a little bit about myself. As Greg mentioned, I'm a partner in the Gowling's Vancouver office. I've been practicing M&A, both public and private, for over 25 years. For 4.5 years, I was the leader of Gowling's national M&A, private equity, and capital markets practice group. And for 3 years, I was also the co-leader of Gowling's national mining group. I'm very active in the American Bar Association M&A subcommittee for the last 2 American Bar Association Canadian public deal point studies. I was the vice chair of those. I'm very excited to be taking over as the chapter president of Vancouver. I've known about the M&A Club through my work as the national practice group leader for a number of years, even before an office in Vancouver was opened. So I'm excited to sort of work and take the Vancouver group to the next stage. So thank you, Greg.
Okay, thank you, Cindy. So now on to our guest speaker. So Ron Chicoyne is the President and CEO of Lynx Capital. He's going to speak to us today on understanding private equity in the current M&A environment. Ron's got his Bachelor of Commerce degree in honors from Manitoba, 27 years approximately of corporate finance experience, including 8 years as a private equity investor. He's been involved in GPs, LPs, raising fund capital, working with large institutional LPs. The last 17 years has been focused on higher end private company M&A and financings. So I'm going to, and he's also past chairman of Hockey Calgary, which is awesome. So over to you, Ron, for some more input on yourself, on a self bio, and then on with the presentation, Ron.
Thanks, Greg. At least you didn't tell my age. I appreciate that.
Okay, thank you.
It's great to be with you here today. I'm actually in the office. Wherever you may be, I hope everybody's staying safe. These are certainly some unprecedented times. I'm going to speak a little louder for you, so you can hear me. If that's a problem, I would say just do what my wife does. She just mutes me or turns me down all the time, so I'm quite used to that. So that won't be a problem. Today, I'm going to touch on the current environment of what's happening in private equity markets as it relates to M&A. Much of the information that you're going to hear today could easily be applied to what's happening with respect to strategic competitors, but there most certainly will be an M&A slant. So plan is today is to bore you a little bit with my professional background and my firm. Quick overview of private equity and its structure, just to bring everybody up to speed. I'll look at some current trends we are seeing in the private equity market. We'll spend some time going over current and historic EBITDA and debt multiples to see where we are prior to and after COVID. And I'll walk through an example of what it looks like to be a partner with private equity, what deal expansion might look like, and conclude with where we might be going in the near future. As Greg said, I'm a Manitoba boy. I grew up there, went to University of Manitoba, Bachelor of Commerce. After that, decided to go down south and try my stick at competitive golf. And as you can see, I am not on the PGA Tour. Or telling you my age, I'm not on the senior PGA Tour. But obviously, it was not good enough stick to stay down there. But I did end up in New Orleans and working in the investment banking area. Primary focus was on riverboat casinos, believe it or not. And anybody that's been to the Deep South has probably seen a riverboat casino. For those of you who haven't, more than likely been exposed to it during one of those COVID binge sessions watching Ozark. Definitely was crazy times down there. After I left, believe it or not, the governor was indicted for extortion on riverboat gaming. Had no part in that whatsoever, but that was New Orleans, and certainly not a place where I wanted to stay and grow a family. So I moved to Calgary, and at that time I joined the Federal Business Development Bank. Some of the moniker a lot of people used was FubDub, which was the lender of last resort. It was in the process of changing its name to the Business Development Bank of Canada at the time, and the change of direction was to move into some innovative products in the market, and I got involved with subordinated debt and mezzanine transactions for smaller companies. I led the BDC in doing those transactions throughout the country, and ultimately became responsible for teaching coworkers on how to position and sell these both mezzanine and subordinated debt instruments to companies in need of alternative capital. I then ran their BDC's management buyout fund, which was a private equity fund, obviously focused on management buyouts. And then chose to leave the Crown Corporation environment and really get into the private end of the group, and joined a private equity group called Mercantile Bancorp. I was the partner of that firm. I ran its Calgary office and did the majority of the deal origination and negotiation for the firm. We managed capital alongside large institutions, pension funds, and insurance companies who were some of our limited partners. To date, as Greg mentioned, I've sat on about 12 different corporate boards, both public and private companies. One of the boards I currently sit on is backed by a Chicago private equity fund who's a majority shareholder. He also mentioned past chairman of Hockey Calgary. I happen to be the longest standing chairman or president in the history of that organization. And yes, you can ask if I'm crazy for sure. Lynx Capital, founded that in 2005. Really, it wasn't something I planned to do. I stepped away from private equity as there was all kinds of changes that were happening at the time with limited partners and general partners. And we were just having our second child, and I felt the timing was appropriate. When you leave, you send out your email to everybody, letting them know that you're leaving and what you're going to be doing. And in this case, it was nothing. And then my network actually started blowing up a little bit, and people calling me, asking me if I would represent them on transactions. In fact, the first transaction I did was for a gentleman who I bought a company from before, and he had another company, and he said, I'd rather you sit on my side of the table. Did a lot of buying and selling in private equity, so obviously have that experience. A week after that engagement, I was engaged in a $26 million deal, then a $50 million deal, then an $85 million deal, and we've been doing deals over $100 million now. Given the Alberta market, we've had a pause here for the last several years and purposely have not been bringing any companies to market, notwithstanding what was happening in the other parts of the country. Recently, that's changed a little bit. We're engaged on 2 divestitures in the building products area. I try to bring the perspective of a private equity buyer to my clients with regards to positioning and selling companies, as I understand both what private equity and strategic buyers are looking for, having been on both sides. The primary focus at Lynx is on divestitures, but I do get involved in institutional backed capital raises, and I've worked for some private equity funds in sourcing add-on transactions. So just a brief summary on some key points about private equity. It's a partnership that's formed between a general partner who's actively engaged in sourcing and managing investments, and a limited partner, typically pension fund, insurance companies, or endowments, for example, or the primary capital sources. These partners come together to form a private equity fund. In its simplest form, I would say a private equity fund is a pool of capital to make investments following a certain investment thesis. There are generalists that look for good cash flow companies. There are those that are focused on growth, or LBOs or MBOs. There's sector specialists that just may want to get involved with a technology company or an energy company. When you're looking at a private equity firm, it may have more than one fund, and they're all distinct pools of capital. So a private equity group may have 5 funds they're working with, and each fund is mutually exclusive to the other funds, as each fund may have a different investor group. The general partner typically doesn't want to get caught in the conflict of interest between funds. For this reason, PE funds try to keep their investments in a company limited to only one fund. And this is important to know, that there's no cross-investing. You need to know the fund's life and how much capital they have remaining in each specific fund, and I'll touch on that in just a little bit as we go along the presentation. Now, PE funds will not only make initial investments in companies, but they will make follow-on investments. Once a private equity fund is invested in your company, the additional capital they might provide is for growth, additional acquisitions, share buyouts, or in cases like coming through COVID, like we just did, capital for balance sheet repair. When a private equity fund sets its targeted investment size on any one transaction, a lot of the cases is dependent on the size of the fund. Most typically, they limit the investment in any one company to about 10% of the fund size. So if you're looking at a $200 million fund, the most that they would like to invest in any one company would be 20 million. However, most funds like keeping available capital for subsequent transactions, add-ons, and any unplanned events. So the initial investment is unlikely to be the full 20 million in inception on a $200 million fund. Fund time horizon is very important in the way one may structure a deal. The fund is usually finite, and it's typically set at 10 years. So if you're dealing with a fund, it's very important that you know where you are in the fund's life cycle. The way you approach dealing with a fund that's in year 3 is going to look very different than a fund that's in year 8. Year 8 suggests that it's more likely going to be a short-term hold because of the finite life of the fund. This brings into consideration different structuring one should consider. And I'll give you a real-life example of dealing with a private equity-backed company who was in year 8 of their fund. They had a majority share position in a company that they invested in, and they wanted to buy a company I represented. The business I was selling filled a void from a geographic standpoint in their business. And what they wanted to do is bridge some of the contingent consideration we were looking to get and try and bridge that over the next 5 years. And the way they were going to bridge this was going to be based on the company achieving 5-year EBITDA targets. And I thought, wow, 5 years, that's a long time. Now, this additional consideration in this transaction actually moved the deal by about 3 times on EBITDA if they were successful in hitting the target. So it was quite significant. But we're dealing with a fund that's in year 8. And and they didn't have to tell me that they were going to be doing a transaction very soon, and it was very evident. The key negotiation point in this would be change of control, so that the contingent consideration would vest on that change of control if it were to occur, which we expected. I didn't want my shareholders having any contingent consideration possibly being obstructed by new owners who come in and try and change the rules. Even it doesn't matter how it's papered. They can do things that impact EBITDA in the way that they do the business. So it was very important that this was in place. So we were successful in getting that change of control clause, and it wasn't something that happened very quickly, but it was put in place, and the business was sold 6 months later. And what that did is it triggered all contingent consideration and making for some very happy shareholders, and they earned it all at the close of that deal. So some may ask, what happens if private equity firms make an investment and it goes beyond the life of the fund for matters they can't control? And a good example in today's market would be COVID. General partners can get extensions from their LP partners, or in cases of poor performance, if they try and get an extension, I've seen limited partners have other GP partners step in and manage their investment. But there are remedies, but typically you got to look at the 10-year finite period as the area that they want to exit their investments. From a geographic focus, even prior to COVID, there were very little barriers from a geographic standpoint that restricted private equity funds on where they invested. Some funds may choose to focus on specific areas, but not necessarily restricted. What I can tell you, though, is there is a very large presence of US funds that are looking for transactions in Canada. So just briefly dealing with private equity and what are some of the things that you really want to look at. Firstly and foremost is what's their strategic and tactical plans with the business, and where they plan to go in the near future and how they expect to get there. Do they want to add any future acquisitions to the business? Are they going to require any additional investment? You may invest in the company, and if they do other acquisitions, they may want you to invest alongside, or you may not. Then you're dealing with potential dilution. Do they just want organic growth? Sometimes they're happy with an investment that's growing quite quickly, pay off the debt, and sell at a later point in time, hoping for multiple expansion. You need to understand what the plans are early in the process, or there might not be a match with your goals. Due diligence expectations is one thing that sometimes trips up an investment. And what you want to do is try to get that list early in the process to understand what their plan is and how they're going to execute it. Usually they're very detailed, and what you need to know is what outside consultants they'll be using. Are they going to be using an accounting firm for quality of earnings and somebody for environmental assessments? But really, what are their expectations and what are they trying to achieve? One of the key things I found in working with private equity firms is who manages this process on the PE end and what their experience is. Sometimes they'll get a junior guy running some of this process, and it really turns out to be problematic. They just don't have the experience in knowing when to step in and when not. And I've seen some due diligence get out of hand. So if it's not managed properly, if you're an advisor or you're an owner, you got to know or know when to have somebody to step in to say this is enough. And I've more than once needed to replace this person in a transaction. Board of directors and governance. Unfortunately, not all PE funds are created equal. And you really need to know how the board's going to be constituted. Are they going to have independent directors or not? What processes at the board levels are going to be in place? What I have seen, not all the time, it's more the exception, but I've seen private equity groups abandon some of the expected governance and try and run it like a family business, which is totally inexcusable. It's important that if you're looking at a private equity firm, to talk with those involved in past investments and understand the private equity group's historically dealings. I can't overemphasize that. So just a few trends that are going on in private equity. If you've been listening to the business news lately, you most certainly heard of SPACs, which are special purpose acquisition companies. Really what it is it's a blind pool of capital that is raised in the public markets. And the intent is to find a transaction to invest in. Once they find that transaction, they do their due diligence, and at the completion and closing of the transaction, it then becomes a public company on one of the exchanges. Now, for those in Alberta, SPACs are very similar to JCPs, junior capital pools, or CPCs, capital pool companies that would raise money in Canada hoping to complete transactions. But they're impacting private equity, and there's more than two ways, but I'll speak of the major ones here. And it's happening at the middle to the higher end of the market. Firstly, SPACs, sorry, a question there? I'll get to it. Mostly at the middle or high end of the market, SPACs are in direct competition for new deals with private equity. SPACs are able to provide liquidity in public markets and requires less due diligence than the IPO route. One can typically have publicly traded company much faster through a SPAC than going public. So for companies to monetize, SPACs are an interesting alternative. Secondly, SPACs are providing a liquidity opportunity to existing private equity investments where they are not forced to go public through an IPO. Private equity funds are selling some of their holdings directly to these SPACs as a means of an exit. It'll be very interesting how the SPAC area continues to develop over the next 12 years. Right now, I would say it's looking a little oversaturated in the market, and they have a finite time to deploy capital. So it'll be interesting, all developments. When we look at private equity right now, some wonder how big this market is and where it's going. Preqin covers private equity fund universe, and they stated in Q4 of 2020 that there's almost 4,000 funds out trying to raise capital. This is near record highs. Realistically, if you think of each fund has a 10-year life, you should expect at any time 10% of total funds outstanding would be out raising capital if they're going to keep going. So with Preqin covering almost 34,000 funds, it looks like there's probably going to be some more growth in private equity. Now, not all these 4,000 funds are going to close, but private equity is not going away. The one aspect that isn't measured in their stat is the total dollars, as some funds may be larger than others, and it would certainly skew some of the private equity dollars and where it's ending up. There was a note came out recently. S&P said there's currently $1.9 trillion in dry powder waiting to invest. So private equity market is certainly immense. With Canada having what I would call a limited amount of private equity funds, I always get asked, how much interest do you see from the US? Funds overall, both in Canada and the US, have really formalized their marketing efforts. A lot of them have hired dedicated business development professionals to go out and source transactions. It wasn't like that 10 years ago. They are not involved in the business process. They just try and find deals, and they reach out to everybody where they could potentially see a deal and just try and bring a deal into the shop. The second point is you now have specialty firms who popped up, and they just find transactions. They don't have capital. They don't manage investments. They just bird dog. So they may work for a group of private equity funds. Actually, I've seen some guys, almost 100 funds and some family offices, and they're just plugged in. And they have an excellent pulse of what's happening at any given time in the market. So almost any day from the perspective of a corporate finance advisor like myself, investment banker, I receive every day probably 2 to 3 prospecting emails or phone calls from funds looking for deals. There's no shortage of private equity out there. If it's a good company, you can find a home. So really, given this inflow of constant inquiries, I actually developed a newsletter. I send it out quarterly. It's called Links List of Multiples and Buyers. It discusses updated valuation and debt multiples in the market. But what it does is also lists the select areas that private equity and strategics are looking to invest in both platforms and add-ons. So this is just one page of the document. It just really shows what we send out quarterly. And obviously, I'm not able to list every potential transaction, but try to highlight some of the areas of interest each quarter that might be of particular interest. PE, tangible enterprise value to EBITDA. As part of our newsletter, some of the information is on the multiple part, and this is the area where we would discuss that. Now, some professionals don't like to go out and like to keep the multiples to themselves, and I'm not of that Silk, I like to go and think that it's important that business owners know what's going on in the market. So PE, tangible enterprise value to EBITDA, is the multiple, the EBITDA multiple. What multiple did you get? So, and there's a lot of different ways of looking at it. Some people will try and take an average, but historically, a lot of the quotes that are out there on multiples are given on the trailing 12 months. And these are the multiples that we're looking at as we go through this analysis. So I've looked at the data set going back to 2018 to give one a feel of what valuation multiples look prior to COVID and where we are currently. Data going back to 2003 is represented in the table, which is really more of a long-term multiple. So prior to Q1 of 2020, when the virus took hold in North America, PE multiples were running at the high part of their historical range and then began to fall off in Q2. Deals in the $25 to $50 million range in Q4 2020 were back up to the historical range that we saw prior to COVID at 6.8, with the long-term historical average being 6.4. Similarly, deals in the $50 to $100 million range are also trading at the 2018 to 20 average of 8.2, when the historical average has been at 7.3. The larger deals are where valuation in private equity has broken down a little and not fully recovered as of yet. So deals between 100 and 250 million in Q3 of 2019 traded at as high as 10.3 times. The average multiple for all of 2019 for deals between 100 and 250 million averaged 9.4 times. In the last quarter, the multiples on these size deals were getting closed at an average of 7.7 times EBITDA. There's some kind of disconnect going on in the market. So when you look at private equity total debt to EBITDA, we're looking at total debt multiples, term debt, subordinated debt, mezzanine, all added together divided by the EBITDA. Historically, there's a very strong positive correlation between total debt multiples and the EBITDA multiples that we looked at on the previous slide. When COVID hit, the debt markets basically shut off. Only premium deals were getting completed, and there's actually no certainty of that even happening. Volume of transactions were really low. Senior debt was very difficult to attain due to the uncertainty in the market, and total debt multiples fell as low as 2.7 times in deals in the $50 to $100 million range. So this senior debt gap was being filled a few different ways. Number one, with increased amounts of subordinated debt and mezzanine debt, along with investors putting more capital into transaction to bridge deals, whether it came from the private equity or the seller. To put that into perspective, sub-debt and mezzanine in Q2 and Q3 of 2000 were averaging twice the amount of debt compared to the historical amounts they'd provide on any transaction beforehand. This was a big windfall for sub-debt. So there's a little bit disconnect occurring as we looked at the $50 to $100 million deals. The disconnect is that EBITDA multiples are above average at 8.2 times, yet total debt to EBITDA is at 3.5 times, is below the average of the last 2 years of 3.9 and below the long-term average of 3.8, yet we have a premium multiple. Remember, there's a strong correlation, a very strong correlation between debt multiples and EBITDA. Then when you look at deals over 100 million, we see much higher debt multiples at 4.7 times, yet the EBITDA is below average at 7.7. So what has happened during COVID? Private equity seems to be relying on less debt to complete certain transactions. And that's what you're seeing in transactions between 50 and 100 million. They're shoring it up with more equity, being debt averse overall. They don't know, there's still uncertainty in the market and they don't know when it's going to end. On deals over 100 million, honestly, I'm still not certain on the higher leverage on these deals. I really want to see how this is going to play out. And I expect those multiples to compress on the debt side. And personally, I haven't seen these high debt multiples in the market. So I'm just wondering, is there some data that's being skewed by something? But what I have seen is during Q2 and Q3, select deals were being completed. From a reporting standpoint, multiples held up very well with the deals getting done. And most of those deals had little or no impact from the pandemic. Arguably, overall, the data shows EBITDA multiples were not going down that much, but one has to keep in mind that premium valued companies were the ones being closed. Those deals certainly benefit as they garnered higher than expected multiples historically. And there was a high competition for these deals from investors wanting these transactions. With both the valuation debt multiples having some historical divergence, I expect we'll probably see some reversion to the mean in both cases. So when looking at the financial markets as a leading indicator, the private equity market has the highest correlation with the S&P 500 and the Russell 2000. Correlation falls off with NASDAQ. I guess there's too much technology tilt there. TSX, too much Canadian exposure. We'll go banks and oils with that. And so when we look at this information, private equity markets are obviously not as liquid as public markets, and shocks to the market are usually smoothed out with the PE multiples. The correlation between the S&P 500 and the Russell, we found out that it will lag. If you lag it 2 or 3 quarters, you actually have higher correlation. So can the Russell and the S&P 500 be a predictor of the PE market? However, but it's not perfect. But it's going to give you some guidance on which one should expect with multiples going forward. What you will not see is wild swings in PE multiples that you will see with stock indexes. So when COVID hit, you saw stock indexes fall off the cliff, whereas PE multiples in subsequent quarters pulled back a little, but not a whole bunch, not the same percentage. PE investors have the luxury to take their time when closing transactions, and if they choose to, they can wait things out. Things right now, I think, are just in the process of normalizing overall as we're starting to have some of that uncertainty lift, some of it anyways. So when the PE investor makes an investment, they'll make it one of 2 ways. They'll make it in a platform company or an add-on. So a platform company is an initial investment that a private equity group would make, and they would plan to grow it. And they'll make acquisitions of other companies, and those acquisitions will be considered as add-ons. So according to PitchBook, add-ons right now represent 70% of what private equity invests in. So if you're looking to be a platform company, 30% of the investments are in platform. So it's something that has to be taken into consideration. So when you compare the two, platform companies usually require a reinvestment of capital at close. You're going to invest into the new company. You're going to be part of that growth. You're the core growth avenue. Secondly, add-ons, you may be able to maximize all your cash proceeds at close. You certainly can take more off the table, but you might be able to invest. Management is key in platform investments to run the business. So when they're looking at a platform company, management's going to be very key. Whereas on add-on transactions, it's going to be a complement. In some case, there may be acquisitions that result in key management of add-on companies taking a significant role. Continuity of the entire team is very important with platform companies, and with add-ons, you have a core management team that's already in place. So really not unusual to see management being let go post-acquisition and others being very key pieces. Example, CFO might be a duplicated position and just might be eliminated. Multiple expansion within a platform company takes place as the company grows organically or through acquisition. With an add-on, if you're rolling over an investment into a platform company, any new equity rolled over may be subject to the platform company's multiple immediately upon close. So you might have a higher multiple that you vend into. So what is deal size expansion? As you move up in deal size, this table clearly illustrates how long-term multiples also increase. Businesses in the $100 to $250 million range typically trade at a 40% premium to deals in the $10 to $25 million range. So if you think you have a company that's valued over 100 million on average, and it has the EBITDA multiple being valued of 8.2 times, and they're focused on acquiring deals in the $10 to $25 million range, without doing anything, you should be able to get a 40% lift on the acquisition for just closing it. Obviously, capital structure is going to come into play, but this is how deal expansion can come to be of a benefit to a higher valued company. So partnering with private equity, let's walk through an example. In this example, I just want to look at just what happens to the initial investment and not take into account any organic growth. I just want to examine what happens with the overall evaluation. We have a company with 3.7 million trailing 12 months EBITDA, has agreed to be purchased for 5.7 times EBITDA, totaling 21.1 million, all consistent with the deal ranges and multiples we just reviewed. There's going to be no long-term debt on the business, and the company is going to have to reinvest 15% or 3.16 million into a newly formed entity at the same class of shares. So if we use that 5.7 times multiple and the 3.7 of EBITDA, we'll arrive at a tangible enterprise value of 21 million. In this example, again, there's no long-term debt, so we don't need to net out anything to get to the equity value. So how is this purchase price being funded? Using a debt to equity ratio of 3.3 times, we'll be a little conservative here, and allowing room for operating line, results in $8.9 million of required equity to fund the transaction, as you're going to fund 12.2 of it with debt. It's interesting, due to the leverage amount, the seller's 15% equity rollover investment to 3.16 million, with the leverage put into place, now represents 35.6% equity. The private equity investor funds the remaining 5.7 for a 64.4% equity position. So I'm going to keep this in its simplest form, standalone. It's part of a larger company valued at 100 million, but I want to keep it separate just so we can do the analysis. With the larger company worth over 100 and its EBITDA multiple of 8.2, as we discussed earlier, the higher multiple results in an increased tangible enterprise value of 30.3 million when applied to the acquired company. That's the 40% return we talked about. But now we have to address the long-term debt of 12.2 million. We deduct that and we end up at an equity value of 18.1. This is what the company is worth within the new company at the higher multiple. The original 15% rollover by the owner now represents 6.5 million in value. This isn't compared to 3.16 that he didn't take off the table and put into the transaction. And obviously it's a paper gain. So if we added that incremental 3.3 million gain through this transaction to the original tangible enterprise of 21.1, did a little bit of reverse engineering with a new value of 24.3 and EBITDA 3.7, the actual multiple is 6.6 that the vendor got on the transaction. This is an increase of 22% in value to the shareholders by rolling over 15% tax-free into the business. Obviously, this is not liquid, but the shareholder has monetized part of its investment. It's not unusual in cases where I've done transactions where this slice of equity actually becomes worth more than the original sale proceeds that the vendor got on the original company. So timing is not always perfect. So why private equity? Sometimes it's not the right timing for strategics. This is an example of a company we took to the market. It reached out to several strategics as well as private equity. Some of the strategics were not interested at all, and the timing didn't fit well with any of them to do a transaction. There was nothing wrong with the business. In fact, it was still growing quite rapidly. Private equity was interested, and the table just gives you a summary of the offers that we received. Most of the offers required that the shareholder invest a certain percentage into the business, which was somewhere around 10 to 25%. The fact is, private equity was willing to step up in when strategics weren't. The other thing to note going through this process is value is perceived very differently from different parties. I always tell my clients when we're going through a process, never take any offer personally because they're looking at it through a different lens every time. As you can see in this transaction, we've had as low as a $65 million to $120 million offer for the business. Moving forward, I see a little bit of a similar setup than when we came out of the financial crisis last time, especially in Canada. Uncertainty still exists for sure with COVID. Now we got variants and vaccines, or when are we getting them? When are we getting back to normal? But there is a huge amount of stimulus in the market. After the financial crisis, some good companies managed well through the downturn and were very well positioned for continued growth. This time, companies like building materials, outdoor rec, pet products are very well positioned, just to name a few. Acquisitions are becoming even more focused on management, and that has been a continued trend with private equity. The succession of ownership with private equity is of the utmost importance and is placing a larger premium on good management teams that will stick around. Normalizations. Normalizations are huge right now. There are so many things that happened in the last 14 months that really aren't normal. So how do you arrive at your normalized EBITDA? This is an exercise in itself for sure. Revenues, where do you start? The impact of them, the in-depth analysis that you got to do on it. Is anything changing permanently in nature? Can you demonstrate that revenues are going to stay, or are they going to return? What margin? Where are margins going? What are input costs going to be like? Or are they? Is this an inflationary environment where they're going to continue to inflate? What's going on with lumber prices? Are there any one-time costs that need to be adjusted? Are there costs that will be permanently disappearing? And then you got to do adjustments for subsidies, Canadian emergency wage subsidy, rental subsidy. These are gifts and you got to normalize them out. So right now, working with two building products companies who've had some incredible success through COVID and looking to divest. And they're running on all cylinders right now. We're going through a due diligence process. So the questions are revolving around how much of the revenues are inflated due to COVID? Is this temporary in nature? What is the new normal? Increases the input costs. Lumber, how long will that last? What expenses will return? This is an interesting one. So this particular company we're dealing with had huge presence at a lot of trade shows. Last year, everything was virtual. It made them open their eyes on how to do their business differently. Going forward, they're going to have a smaller footprint at trade shows. They're going to do their marketing differently, dinners, flights, advertising. It's changed the way they think about their business. And COVID has transformed so many companies, how they think about their business. So in looking at transactions right now, you might run into bridging some gaps on valuation expectations just due to the uncertainty going forward. You'll have to remedy that. We have inflation. It's expected. We should see rates increasing. Multiples are inversely related. So what's going to be the impact on valuation multiples? We're on a high point of the range right now. But I'll leave you with this. Private equity always has fresh capital ready to deploy, whereas timing for strategics is sometimes questionable and may be constrained. But private equity is not the end all be all. It's an alternative that has to be considered. Right now, the two deals we're doing, we're selling them both to strategics. So that would conclude the presentation here, and I'd be happy to answer any questions. I saw a couple pop up, but I just thought I would address them right at the end of the presentation.
Yeah, great. Thanks, Ron. Very informative. Got a couple of questions here. Going back to the beginning, I think it was slide 6 where you talked about governance. Stephen's got a question here. Can you give some examples of poor governance, i.e., trying to not run it like a family business, and some other, comments on governance? So I'll open that one up to you, and then I'll have a few comments on that too. Go ahead,
Sure.
Ron.
Sure. I was actually sitting on a board of directors of a private equity fund backed investment. It was actually, they asked me to come on. I actually sold them the business and remained on. And we were going through the process of doing some expansion with the plant. And there was certain capital expenditures that were needed to be done that were not authorized at the board level and needed to be authorized at the board level. I came to the board meeting and found out that actually they went ahead and made the investment, and it was substantially over what was budgeted from the board, made the investment and pushed it through the board at a later point in time. Just not acceptable. You got to run through your processes and keep your processes in place from a governance perspective. Just because you're the majority shareholder, don't go outside what you should be doing from a governance perspective.
Yeah, and we're seeing a lot of family run businesses, second and third generations, bringing in independent directors and even a lead director that's maybe taking the position of the, chairman who was the founder of the business, just to give some, additional insight and some more strategic management. And we've seen private equity firms, after their buy-in, drop, you know, one or two outside directors into the board and revamp the governance charter, audit committee charter, terms of reference for the directors, and just shore that up to a higher standard, akin almost to a pubco level, but below a pubco level, but more so than having nothing or having just an old-fashioned family charter.
Yeah, where I would be worried, I'd be a little worried if I have a private equity fund that comes in and they establish a board of directors, they give the vendor a seat and they take 2 seats and they don't bring any independence in. You need the independence there. Without the independence, you're swimming uphill.
Yeah. And then Alex got a question here about Q4 2020 debt multiples and EBITDA multiples divergence. We generally see this divergence coming out of a crisis because equity investors are able to look forward more, but debt investors are still bound by more recent historic trends. Does the presenter agree with that? So Ron, over to you.
Well, when we're talking here from valuation perspective, and we're talking about total debt to EBITDA and EBITDA multiples, the banks are going to be the first one that close the doors a lot of the times, and I seen that in the financial crisis. It was no different. I think what happened here is there was a lot of closing of the doors, which opened up some doors for sub debt and mezzanine, and required more equity investment from both the seller or the private equity fund to get transactions done. So what I see is the divergence right now is that played out how I would have expected it to play out with the debt. But when I'm seeing certain ratios at certain levels that divergence, that's where I'm seeing the difference. So you look at this chart here right now, when you got 3.5 times at the $50 to $100 million on the total debt, and they're getting 8.2 multiples, and the 100 to 250 million somehow is at 4.7 and they're only getting 7.7. So one is being funded a lot more with equity and the other one is being funded a lot more with debt. That's the divergence I don't understand right now. And I think that'll sort itself out in the coming quarters, but at the end of Q4, it looks awful.
Yeah. What about a comment on SPACs? You're seeing just a ton more of these, and on BNN News, they're just like really, really, talking about SPACs. And where do you see that going?
Well, so when you look at SPACs, each transaction's at a different value. There's some that are really large and there's some that are really small. There's going to be a falling out of it, I think, a little bit. If you actually look at the value of SPACs, a lot of them were, from a stock trading perspective, were trading way up high on speculation and have since pulled back. A lot of them are, they get issued at $10. And it's not unusual to see them trading around the $10 mark. In fact, some of them trading below $10. So it kind of sorted itself out. There's some good investors out there that are going to do a good job with it. And then there's some other people that don't have the reputation, and it brings into question if they're actually going to be able to deploy their capital or have to give the capital back, as some of the conditions and some of the offerings are there. So they may have to do that. So it will be interesting. I think I'm not 100% sure on it. There's a finite period where they have to invest. I know some of them are 18 months. So we got a little bit of a runway here.
Okay, Ron, just a question from Brom, or a comment from Brom. Brom said he wants to know about Qs and where is that on the financials, and how does that affect M&A transactions? What are you seeing? What are you seeing CPA firms advise their clients on receiving Qs in the advent of a deal?
Qs define. What do you mean by Qs exactly?
The Canadian subsidy from
Trudeau.
Trudeau.
The Canadian emergency wage subsidy. Okay, yeah. I seen this from accounting firms a few different ways. One of the companies I sit on the board with, they've put it in their operations, and I've strongly suggested, well, it's not operational, and they made sure that there's a line item in there to disclose it. Yeah. And in some other firms, I've seen them go ahead and put it in the other income. So I'd prefer to see it in other income. And any of my clients that ask me, I say, well, in turn, put it in other income because it should probably be normalized. It shouldn't probably, it should be normalized out. So
yeah,
if you're earning that, great. That's going to support your business, but it's not going to.
It's not going forever.
And it's not going to increase the value of your business. So
no.
It might give you a little additional working capital. In fact, there's some companies that have done really well and collected that, and it's just a bonus for them. It's just additional cash.
Well, some firms have collected it and actually made budget and been profitable just because of it.
No, 100%. And in some cases, it served its purpose for sure.
Mm-hmm. I don't see any other questions. Maria, did you have a question at all?
No, I was just getting ready to thank Ron if there were no other questions.
Okay. Oh, there seems to be, there's one more here on the Q&A. Are you seeing any impact, Ron, on the reclassification of pref shares as debt?
You know what? It's when you're going through the valuation of the company, there's a whole bunch of stuff that you have to normalize. You know, whether it's pref shares or debt, you make it doesn't change anything. You know, it's like, and I'll give you an example. It's like the U.S. right now. The U.S. with regards to some of their accounting standards changed that there's no more operating leases. There's only capital leases. So if you compare a company in Canada directly compare a company in Canada to one in the U.S., one of the things you have to do is you have to do a normalization if your company has operating leases and they have capital, because one's going to hit the EBITDA and the other one's on the balance sheet. So when accountants and things change, they just make more work for us, but you just have to understand really what you have to normalize and make sure it's done properly to arrive at the right valuation.
Yeah, and by and large, pref shares is deemed dead on the balance sheet anyways on most M&A transactions. Yeah. Great. Okay, over to you, Maria.
Thank you, Greg. So thank you, Ron, for an insightful presentation on the current trends in private equity, in particular around your commentary on SPACs, valuation and multiples, achieving value through add-on investments, and when looking forward, paying particular attention to critical management succession, EBITDA normalizations, and earnouts. We really, understood that. So we appreciate your time in walking us through these trends that you're seeing. And so on my behalf, on behalf of the M&A Club and all of the audience, a special vote of thanks for being here today and for your time, Ron.
Thanks, Maria.
So great. Bram, I don't know if you want to say a few words.
Thank you, Ron. I think everybody did a great job, especially Ron. Very valuable and important information, and we don't always get this kind of angle from someone with your experience, long experience. So thank you for this expose, as it were. Very, very important, very useful. Yeah.
Thank you.
So thanks, everyone. We'll have more webinars next week. And thank you, Maria, for doing this. Thank you, Greg, and thank you, Cindy, for your leadership. And we'll talk soon.
Okay, bye, everybody.
Stay well.
Bye, everybody.